Welcome to the Mike the Money Coach Show, where we talk about tax tips, money making techniques, retirement planning, and more. And here is our host, Mike Velarde, the Money Coach.
On today's show, I'm your host, Mike Velarde, and we got some great tips for you today. You know, it's one thing to have money. Money's always nice, right? You got plenty of cash. But you know what? The one thing about cash is you could always lose it. You don't want your money to go up in flames, and that can happen, right? Right here, there's $100 up in flames, right? Just like nothing. There you can see it. All right? That can happen to you. That could happen to anybody. So we want to give you a skill set. A skill set that even if you lost all your money, even if you're burned up and this $100 gets burned and it becomes nothing, it doesn't matter. You want to be able to walk into any economy, any situation, and have the skill set and the techniques that you can make money with. Now, today happens to be April 1 week before your taxes are due and need to be filed, and that still gives you a tax deduction of an IRA. And that's what we're going to talk about today. And we're going to talk about some different things in the economy, some things that are happening that you need to know about. As you know, we have interest rates going up. We have banks failing. We have crude oil back on the rise. Why? Because we decided to cut domestic production. And as a result, the Saudis decided they're going to cut their production, so they're going to have higher prices. These are all things we're going to talk about on today's show. But first, let's talk about the IRAs. Why an IRA? Well, first of all, what is a traditional IRA? Anyone who earns or has what's called taxable compensation. What is taxable compensation? That's a W-2. If you have W-2 income, or even if you are a real estate professional, right, and you get a 1099, you can still invest in a traditional IRA. And what an IRA does is it allows you to put away your money for retirement. So even though last year is dead and gone, 2022, you can still get a deduction for 2022 by investing in an IRA, making an IRA contribution before the tax filing deadline, which is next week. So that gives you an ability to lower your taxes for last year now and still save some money for retirement. Okay, and that's used with the traditional IRA. Now, I'm going to read some statistics about traditional IRAs, and then we're going to talk a little about the Roth IRA, which is another type of IRA. Now, you can put money into your IRA up till the time you're 72, then you got to start withdrawing it. All right, that's when you get the withdrawal. Now, there's what's called, there's some requirements or some limitations what you can do. How much can you invest in an IRA? So if let's say you have a tax liability, you owe the government $3,000, you don't want to pay that $3,000 over to the government because you're going to hit with penalties, you're going to hit with interest. Well, you can take up to $7,500 if you're over the age of 50, $6,500 if you're under the age of 50, and make a contribution to your IRA before you file your tax return next week, and you'll get a tax deduction for that amount, for that $6,500 or $7,500. Well, depending on which tax bracket you're in, is going to determine how much it's going to save you in taxes, right? If you're in the 33% tax bracket, you're going to save $2,000 in taxes. If you're in a lower tax bracket, you're going to save less, depending on the tax bracket you're in. But that is very, very important because you have until the April tax filing deadline to make your contributions. Okay, now, let's talk about with the withdrawals of the IRA after you make the contributions. Qualified withdrawals after the age of 59 and a half are taxed as regular income at the state and federal level. Early withdrawals prior to then will be taxed the same and incur a 10% penalty fee. And again, there are some exceptions, health issues, there's some exceptions. So keep that in mind. So usually people make less money in retirement. So as a result, the purpose of an IRA is when you pull out the money, right? You're going to get taxed less, and then you have money for your old age. That's what this is about. Now, there's another kind of IRA. It's called a Roth IRA. A Roth IRA, if you're a single person and you have modified income of adjusted gross income of less than $138,000, right, you can invest in a Roth IRA. Roth IRA uses after-tax money. In other words, instead of you getting a tax deduction for it now, it's money, you get no tax deduction when you put it into the Roth. But as it accumulates over time, you're allowed to take out that money without being taxed. Now, the stipulation with a Roth IRA is that you have to hold it for 5 years before you can take any withdrawals. So if you're going to use a Roth IRA, make sure that you know that for 5 years you can't touch it. That's very, very important. All right? And then you have 401ks. The maximum you can put in your 401k for this year is $22,500. You can put in $30,000 if you're age 50 or over. And the important thing about IRAs is making sure that you do have enough money set aside for your future when you get older. Now, we're going to talk a little about what's happening right now in the economy. Banks, as you probably know, there's been some bank failures. Why? Because banks invested in government-issued securities. In other words, treasury bonds, right? When they bought them and they invested in them, the interest rates were really low, 2%, 3%. And over the last few months, due to inflation, interest rates have gone up now to 7%. And in some cases, they're going even higher. And so bank investments, right, you spend $100 and you get a 2% return. Well, who's going to want that 2% return? Nobody, when they can get 7%. So you're going to have to discount the value of that bond that you paid $100 for, and as a result, you're going to take, the banks are taking losses, and they get forced to liquidate more and more as people come in wanting their deposits. So that's one of the crises we're looking at. The other crisis, of course, is what's happening in the oil markets again. Saudi Arabia decided to cut production. As a result, oil prices are starting to go up, and this is causing another inflationary effect. So let's talk about some good investments and what we can do to make some money with this situation going on. So first and foremost, we want to take a look at some of these charts. Now, this is a chart of oil. This is the recent chart for oil, if you can see that. And you'll notice that crude oil here jumped just a week ago from a little above $75 to over $80. And it's jumped, and it has not closed that gap since. Why? This is based on Saudi Arabia cutting production. So as a result, we're seeing higher and higher oil prices at the gas pump now as a result of this. And I think oil is going to continue to go up because as long as the United States decides not to supply the country and buy foreign oil, we're going to have an issue with this. Well, where do you want to put your money then? Well, let's take a look. Here's Exxon. Guess what Exxon did? Exxon, when Saudi Arabia, they also jumped, and they gapped, and they haven't closed that gap. They're selling at $115.64. They have an excellent dividend, and if you can see from the chart, you see we have higher bottoms all the way up, higher bottoms, and once we cross 120, that'll be another buy signal. All right, so we want to buy strength. You always want to buy strength because that's where the money is. You go with the trend. When we're trading in stocks or commodities, we always the safest thing we can do is go with the trend. When you buck the trend, your chances of winning are greatly reduced. So sometimes we wait until the market tells us what to do. Now, the other thing that the government is doing is they're requiring, almost mandating to some degree, that companies invest in green new technologies, right? So there are some companies out there that are making electric vehicles, and these vehicles might or might not take off. Here's a chart of a company called Arcimoto. Okay, they make a three-wheel electric vehicle that you get a tax credit for. It's credited on your taxes as if you bought an electric motorcycle. It's classified as a motorcycle, right? Now, here's what happened with this stock. This stock was a couple of weeks ago just at $6. And when we come back, we're going to cover this stock. We got to go to a commercial break. I'll be back in a minute.
Tax alert! Tax alert!
I was receiving letter after letter from the IRS.
I got Mike Velarde on the phone and I said, Mike, I got a problem.
He took the pressure off my shoulders.
He just made me feel like I had Superman on my side.
Trust me, he's the man to go to.
IRS problems? I'm Mike Velarde, enrolled agent. I can help. My company, Winning Tax Solutions, has always gotten our clients the best possible results. Visit us at winningtaxsolutions.com or call us today.
You're watching Mike the Money Coach, where we talk about tax tips, money-making techniques, retirement planning, and more. Now, welcome back to the show.
All right, welcome back to the show. So what we want to talk about is sometimes the government is trying to steer us in one direction. Now, is that a good thing or a bad thing? Well, it depends, right? The government currently, the Biden administration, is steering people towards electric vehicles, right? The Green New Deal. They're asking retirement planners to buy stakes in companies that invest in electric vehicles or involved in the Green New Deal. How do we know if that would be a good investment or a bad investment? Well, there's certain techniques I want to teach you because the market will tell you what it's going to do when it does it. So let me give you an example. What's called a breakout, right? If you see a stock that is trending in an area like this, and I'm going to use this again as an example. When you see, this is Arcimoto, the symbol is FUV, okay? You see where they made an announcement on this day. It was trading at $6 in the morning, and in the afternoon, it was trading at $2.50. What happened? They decided to sell more stock to create cash to be able to fund the business. Well, since that time, the stock is trading in the range of $2.50 all the way down here at $1.20 something. Now it is starting to rally. The stock is starting to go back up. So it's gone up 40 cents in the last 2 weeks. But when would we want to buy this stock? When would this be a good investment for us? Well, it's going to be when it breaks above the highest high over the last several months. In other words, when we see the stock can get above that 250 that it was at, when it sold off, when it closes this gap. Let me make a circle here so you can see the gap and you'll have an understanding of what I'm talking about. When we close this gap, right? When we close that gap, we break above this high here, this 250 again, and then we should continue to go higher. We always want to go with the momentum. Now, of course, the government is trying to get hedge funds and whatnot to invest in companies like this because they're green, right? But that doesn't necessarily make it good for us. In other words, we want the market to tell us what it's going to do, and then when we know what it's going to do, we go with it. We always want to go with the trend. We never want to go against the trend because going against the trend could be an absolute disaster. And let's just take an example. Back to crude oil, right? Now, crude oil, this is a 3-year, this goes back to May 2020, when oil was down at negative $40, okay? Once it was negative $40, right? Once it broke above 20, which was our resistance point, all right? I'm going to make a line on the chart so you can see that. Once we broke above 20, it broke out and continued to go higher. All right, now I at that time happened to buy Exxon stock. I heavily invested in Exxon stock at $48 a share. Now, when it started getting 85, 90, I started selling some of that position. Then I bought some back, and Exxon continues to go up, because the trend has not changed. The oil trend has continued to be higher. Now, what did happen here is we came back, we tested what's known as a support area, right? These are support areas, right? You have support, resistance, and I'll probably need to explain that a little bit better on some of these charts, right? A support area, like here at 60 on crude oil, I'm going to use crude oil as an example, is when it comes down to but does not break below. So that's support. When it can't get below that floor and then continues to go up and then it happens again. So we see once we got above 20, we continued to go higher. And when it came down to 60, here, that was our support, continued to go higher, came back down, retested 60, and then what did it do? It broke out above 80 and continued to go all the way up to the 120 area. Now it came back down, right, to 80, continued to go up, went to retest that 60 or that 60 area one other time, and now it's broken out again to the upside with the news that Saudi Arabia is going to produce less crude and the United States is not going to add to any of its supply. So as a result, this gives us some good opportunities in oil stocks, which pay good dividends, which make a lot of money. Okay, they're making billions and billions of dollars. And we can see from the chart, and this one happens to be Exxon in particular. Exxon not only pays a pretty hefty dividend, but they also show tremendous strength, where you have the higher bottoms, right, and higher highs, right? Now, if we break above 120, I'm buying Exxon like crazy because it'll probably go to 140, all right? And that's what we want to do. We want to use techniques that are going to get, you know, as best you can, I can't say guarantee, that's not the right word, but give you the highest probability of making money in the markets, especially in this particular market, because what we're seeing is we're seeing an inflationary cycle very, very similar to what we saw in the 1970s. Now, if you're young enough, you might, and haven't lived through the 70s, you don't know what it was like. I remember I was 13 in 1973 when we had the first oil crisis, and then we had another one back in 79 under Jimmy Carter, and you had to you could only get gas every other day, depending on if you had an even license plate or an odd. That's the day you can get gas, and there were long lines. And it was the first time that gasoline at the pump broke above $1 a gallon. Okay, and so we're in a similar economic situation. Now, interest rates ended up going all the way up to 20% under Carter. And it was wonderful if you had a money market, right? I was able to get a student loan. I was in grad school. And I remember I got this loan, from this college loan, and I was able to invest it and make 18% on my money because interest rates were so high. Now, we're seeing a trend now in order to fight inflation. The Fed is raising interest rates again and again. And this is going to cause a problem in the real estate market because it becomes so much more expensive for you to buy a home. So we have to look at the trends, make our investment decisions based on where the trends are taking us. And I think what I'm going to do in the next segment, the final segment of the show, is just go through some basic rules of some of the best people that ever traded the markets, who've ever made money in this world, okay? One of my favorites is W.D. Gann. He made millions of dollars back in, from 1907 to 1952. Was a tremendous trader, had tremendous rules, and was very disciplined about the way he made money. Now, there's other people who've done, similar things. Warren Buffett, of course, comes to mind. His trading technique has made him millions and billions of dollars. So we want to follow some of the most successful people in this show. That's what I want to do for you, is I want to just teach you the techniques that work best for some of the wealthiest people that ever walked on this earth. And so it's my job to help you make money, and not just make money for the sake of making money, but for the sake of being able to have that confidence that no matter where you are, you have an ability, a skill set that'll last the rest of your life. You could take the techniques that I'm going to teach you in this show and put them to use. You'll learn them. It's like learning a martial arts move, or you want a skill set that's going to make you wealthy forever. That's the goal. Okay, so we're going to go to another commercial, and we'll be back.
Tax alert! Tax alert!
I was receiving letter after letter from the IRS.
I got Mike Velarde on the phone and I said, Mike, I got a problem.
He took the pressure off my shoulders.
He just made me feel like I had Superman on my side.
Trust me, he's the man to go to.
IRS problems? I'm Mike Velarde, enrolled agent. I can help. My company, Winning Tax Solutions, has always gotten our clients the best possible results. Visit us at winningtaxsolutions.com or call us today.
You're watching Mike the Money Coach, where we talk about tax tips, money-making techniques, retirement planning, and more. Now, welcome back to the show.
Okay, welcome back to the show. All right, so what I want to do in this final last 10 minutes is go over some of the rules that were used by, again, some of the wealthiest people who've ever made money in the markets. All right, and one of those people I'm going to highlight today is W.D. Gann, who was, again, one of my favorites. But here's one of the things that he did. The first rule he had was taking his capital, whatever investment capital that he had, $1,000, $100,000, whatever it is, dividing it into 10 equal units. Why? 10 equal parts, and never risk more than one of those parts on any one trade. So in other words, if he has $1,000, he's not going to risk more than 100 on any one trade. What does that do? That means no matter what happens, whether he wins or he loses, he still has 900 to come back and trade with. So if you're going to trade the market, this is one of his rules, and I think it's a good one. Never give up more than 10% of your capital on any one investment. And always make sure that you use stop losses, right? And I know that the markets are going to try and take those out, so you got to use them in a kind of very smart, technical kind of way, because now we have computer trading, right? And they're going to see where you're going to go protect yourself, and they're going to go look for it. Happened to me many times, right? Where they hit your stop, and then they run it the other way. So, but that doesn't mean that we can get away with not using them, because if we don't, we risk everything, and we can never be in a position where you want to risk everything. So you always need to protect your trade in a way that protects your capital, because protecting your capital is more important than anything else. The third rule that he had was to never overtrade. He said that would be violating your capital rules. So in other words, we want to wait for an opportunity where the odds are in our favor. And if we can't find an opportunity where the odds are at least 80% in our favor, wait. Don't risk it. Why do we want to just jump into a trade and not be sure that we're going to make the money? Why don't we wait until we're sure? We know it's going to work. 80%, at least an 80% chance of losing money, of making money, and then again, use the stop losses. So in the event that we're wrong, because believe me, I've traded for years, and I've been wrong many times, especially in my younger days, right? And without protecting the capital, you could take a beating. You could wipe yourself out. And you never want to be in that position where you go from having a lot of money to, like this, right, to losing it all to nothing. We can't do that. Okay, so another rule, never let a profit turn into a loss. So once you start making money on a trade, like I talked about Exxon, right? I bought it at $48 a share a couple of years ago. Paid great dividends, kept moving up, 85, 90, right? I made sure that I would never lose money on that trade, right? So I had stop losses going up, and then I decided to get out and take, $90, $85, $90. I started pulling the plug, putting money some other places. But then I went back to it because I realized the trend for oil has not changed. And they still pay a great dividend, and they're still going to go up. And when they cross 120, I'm going to buy a hell of a lot more of it. Why? Because I know that's when everybody else is going to buy it. And that's going to be another opportunity. So we never want to let a profit turn into a loss. And here's what I think is the most important trend, and it took me a little while to learn, is not to buck the trend. If we're in a bear market, understand you're in a bear market. Don't start buying crazy stuff. If you're in a bull market, buy. But again, use the rules. Make sure you always protect yourself. The most important thing for making money is understanding the trend. That's why that breakout trade, like I showed you with that FUV stock, right? When do we want to buy it? We don't want to buy it right now at $1.62. We want to buy it when it crosses that 250 line, when it starts making up that gap that's in here. Because this stock has been doing nothing but trending down from $20 all the way right down to $1.62, right? If it's going to go back up again, it's going to have to cross this threshold at 250 where we have the big gap, and then we'll start seeing some action. Now, what's helping this company, of course, is the Biden administration, kind of almost mandating, telling them, listen, don't worry about returns anymore. Let's go with the Green New Deal companies, right? Because this is an electric car maker. They make three-wheel vehicles. They got a great product, right? But until we get a breakout above 250, it's just not a buy. Because we want to be sure when it goes, it's going to continue to go in that direction. So very important. Very important. Never to buck the trend. Now, if you're not sure about something, get out of it. Many times I've sat on the sidelines waiting for an opportunity. Waiting until I saw it. Right? When oil started selling off and went to the negatives, that's when I said, you know what? Oil can't stay negative for very long. And that's when I started taking all my capital and investing it into the oil companies because I knew they had to bounce back. Right? And over 2 years, I doubled all my money because that's exactly what they did. And now oil is, of course, over $80 a barrel. At the time when I started looking at it, it was at 17 and 18. So that's very, very important. If you can save yourself for the big trade, the big winner, that's what you'd like to do. It's kind of like winning the lottery. Now, the other thing is you want to trade in active markets, all right? I got a client of mine, who would raise money for all these different companies. And at one point, he was worth $40 million. But what happened was 2008 hit, and as he said, from the time he went from one stoplight to the next, it was all wiped out. There were small companies, inactive, they all went bankrupt. So all the stock he had that was worth $40 million went to zero, and he couldn't pull it out in cash. So we want to only trade in active markets. The other thing we want to do is we want to diversify our risk. We don't want to put everything in one basket, again, just in case we're wrong, right? So we put a little here, a little there. But again, making sure that our chances of winning are at least 80% or better. Okay, so that's why we want to use these techniques and use rules. If you don't have rules, if you're not set up with rules and you don't know what to do and you're just haphazard about it, well, your chances of making money are a lot less than if you do. Okay, so we want to trade at the market when we see the opportunity, and that's another important thing. Now, we only have a minute left, so I want to stress to you, in the next week, if you can, if you're going to have a tax liability and you have the opportunity to go and invest in an IRA, take $6,000, put it in an IRA, it'll lower your tax liability. It's the only real tax deduction that you have left between the last tax filing deadline. And it's important. I use it every year. I find it to be a great tool because you can figure out how much you want to reduce your risk, and it takes that liability and makes it less. You don't want to sign a tax return telling the government you owe the money, because when you do, they have the ability to penalize you, penalties and interest. Because when you sign that jurat on the return, you told them it's now their money and not yours. So take advantage of this last tax deduction. And until next time, I'm Mike the Money Coach. We'll see you in the next show.
You've been watching the Mike the Money Coach show, where we talk about tax tips, money-making techniques, retirement planning, and many more. Join us again next week with Mike the Money Coach.